Hello and welcome. You're watching KYC, which is Know Your Company, and here we focus and give insights, both actionable as well as powerful, into the fundamentals of single NSE listed company. We pick one company daily, as we do. Today we'll pick Dodla Dairy. We're going to talk about this one. First off, to start off, it's a dairy company incorporated in 1995, listed only in June of 2021. In terms of what it does, one, of course, it does pure dairy, which is it sells milk and dairy based value added products. So it's doing forward integration into value added products and also doing or rather undertaking and competing in the branded consumer market. So that's one part of the business. The other one is Orga Feed. Under the brand name Orga Feed, that business is engaged in seed crushers, manufacturing and dealing in groundnuts, gingerly, cotton, and manufacturing of cattle feed. So that's more towards the backward integration part of the business. So not only does it do milk, it does forward as well as backward integration, and it takes care of the entire supply chain from the farmer or the dairy producer all the way to the final consumer, ensuring that products reach there. Let's talk about the products. These are all the products that they do. Actually, not all, just some of them. And a lot of them are value-added products, as you can see. Buttermilk, Doodh Peda, milk-based sweets, lassi, paneer, curd, ghee, flavored milk, yogurt, and ice creams. Pretty much the whole gamut with regard to milk-based products, which India largely deals with. But in terms of procurement, let's talk about that. They procure from 5 states. 1.4 lakh farmers is who they source from. 8,200 villages is what their procurement spread is across. And they have 7,700 village level collection centers. They call this VLCCs. And they try to grow this and thereby expand the number and the reach from where they are procuring from, because that's the key here, the raw material ingredient, which is milk, and how they're going to actually source better milk at better prices determines how the business will do going forward as well. Processing and logistics. So this is where the phase 2 of the business comes into play. They have 16 processing plants, 2 are in Africa, 14 in India, and they're also looking to expand in Maharashtra, which is expected to happen by FY27. But currently that's how it's placed. They have 885 primary vehicles which transport milk back and forth. They have 169 chilling centers which is able to store milk, and they have a current installed capacity of 24 lakh liters per day. And the Maharashtra plant will add another 10 lakh liters per day to this. So very, very large growth also in the pipeline. Let's talk about product sale. How do they sell? This is broadly the manner in which they sell. They sell through retail parlors. You'll find that even on a Zomato back in the south. They do it through distributors, and then there are direct retail agents. And let's talk a little bit about the distributors and agents. They have around 2,040 distributors, 2,800 agents. In terms of sales offices, they have 55 sales offices. 13 states in India is what they cater to. 90% of the sales come from India. Just about 10% of the sales come from Africa. Africa, largely the market is Kenya and Uganda. They believe that the market is very similar to India, but better margins because there's lower competition. And hence Africa is a very, very important market for them. They follow the same model in Africa as they do in India. What they're doing is, and what they're distributing through is 2,800 agents is what they're using, 2,040 distributors, 317 distributors is what they currently have in Africa. Now, value-added products, because that's going to hold the key going forward. There's also higher competition there. You have the likes of an Amul, a Hudson Agro, all of which are competing for the same piece of the pie. Let's talk about how there has been an increased focus with regard to value-added products. And this we've pulled out straight from the presentation. Over the last 5 years, how value-added products has actually grown versus the total revenue. It was sub 23% in FY20. currently sitting at 26% plus at the end of FY24, growing even faster in FY25, frankly. And in terms of the contribution to total revenue, that's the number. But essentially, value-added products, which was sub 500 crore in FY20 currently, or in FY24, commanded 820 crore of revenue. So very, very fast growing in that sense. But let's talk about the financials now. Let's break the fundamentals down. And what we'll talk about here are all the metrics that we will be discussing. And first, let's talk about those metrics. One, we'll talk about the P&L, which is the income statement, the balance sheet, the cash flow, as well as the return ratios. All important because it's a fast-growing company. You'd want to know how they are in terms of their return ratios because they're investing that capital back into the business. In terms of the other four metrics, shareholding pattern, street cred, valuation, and street coverage. Those are the other four that we'll take you through. So broadly, that's how we're going to be breaking this down. Mahima Vajrajani tracks FMCG for us, and she's joining me on this show to try and break the numbers down on Dodla Dairy. Very interesting company, Mahima. And why don't I allow you to start with the income statement?
Absolutely. Very interesting company in terms of the key metrics. That's your revenue, EBITDA, and margins, as well as net profit. The company has shown resilient growth. In terms of revenue, the 3-year CAGR has been around 17%. 9 months FY25 revenue stood at around 2,800 odd crores. In terms of EBITDA, the 3-year CAGR has been around 6%, so it's been in high single digits. But overall, PAT as well as revenue, both 3-year CAGRs have been in double-digit growth. Net profit 3-year CAGR has been around 10%, which stood at around 192 crores in 9 months FY25. Now, and this has already surpassed the number of FY24 net profit, which was around 167 crores. So, overall, the income statement looks strong for the company, which is why we've given a thumbs up. Now, in terms of operational metrics overall, the average milk production that is measured in lakh liters per day has overall seen an increasing trend. If we compare the average sales for 9 months FY23 to FY25, it stood at around 14 lakh liters per day in FY23, which has gone up to 17.3 lakh liters per day in FY25. In terms of average milk sales, again measured in lakh liters per day, it stood at around 10.6 in 9 months FY23. This is the average 9 months FY23, and 9 months FY25 average has gone up to 11.5 lakh liters per day. So that is on an increasing trend. In terms of the curd sales, which is a value-added product for them, that has increased from 326 metric tons per day in 9 months FY23 to around 366 in 9 months FY25. Value-added products overall, like Harsh was talking about, the share of value-added products to their total revenue is increasing every year. And in terms of the 9 months, if we compare 9 months FY23 to 24 to 25, the overall percentage to sales has gone up from 26.5% to around 34.6%. So this going forward also, will have a better impact on their margins also, because value-added products will always have better margins
and top line,
and top line, of course.
And that's probably what's contributing to the top line growth this year as well, which has been fairly healthy. And sorry, allow you to take it forward.
No, so absolutely. So that's what I was saying, that value-added products is something that is, kind of bringing in the growth for the company overall. But how's the balance sheet looking like, Harsh? Yeah,
it looks like a fairly healthy balance sheet overall, Mahima, because the debt is virtually zero. You're seeing a decentish kind of cash balance. When I'm looking at the cash balances, 103 crore for FY24. For H1 FY25, it's 154 crore, so that change needs to be made. But overall, you're seeing net worth continue to grow at a fairly healthy clip. And you're expecting to also see decentish growth because you'll have profits coming back and getting churned back into the business. And therefore, some of those insights will also be important to understand. Because there is zero debt, the balance sheet just looks really good, and the growth also looks strong, because when you're looking at this 4 or 5 years ago, they had half the capacity. So they've literally doubled capacity, and they're further increasing it by another 30 to 40% over maybe the next 3 to 4 years as the Maharashtra factory takes shape and kickstart. So overall it's a healthy balance sheet to kind of push growth forward.
Absolutely. And in terms of the cash flow position also overall, Harsh, it looks like a decent set of numbers in terms of cash flow from operations. If we see the overall trend for cash flow from operations, the number is slightly higher in first half of FY25. But this is because the overall inventory for the company had come down, which is why there was a cash influx, which is why the number for cash flow from operation is significantly higher as compared to FY24. But overall, in terms of net cash flow position also, that has changed from a negative number to a positive 17 crore in first half of FY25. So because still the net cash flow position is around 17 odd crores, we've taken a conservative approach and given it a neutral rating. But overall, in terms of cash flow performance also, the company seems to be decent. But we'll have to wait and watch out for as to how the entire funding process takes place for the new factory that they're planning to set up in Maharashtra. That will probably be decide as to how the overall cash flow picture will pan out in FY25 overall.
Yeah, possibly. Also, one very quick addition here. So FY24 saw a real increase in the inventory levels, Mahima, and that unwind has happened in H1 FY25. Right. So they've had to procure lesser than what they are selling. I'm just trying to piece this together. And therefore, what you're seeing is lower cash outgo on raw material because they are using a lot of the inventory that they had built up in FY24. So your cash flow in FY24 was weaker, your cash flow from operations, because a lot of that money was sitting in inventory. Right. That inventory unwind is what H1 FY25 cash flow looks like. But giving this a neutral because of this little bit of dichotomy. Right. And this little bit of upswing with regard to inventory levels. We'll also want to quiz management as to whether they expect that to be a trend or is that just a one-off. So,
and in fact, because their inventory cycles might not be longish, right? Because their products are pretty much, they have less expiry dates. So it might be that by the end of FY24, they would have inventory, but within first quarter, that inventory would have been sold off. So that is why, we've given it a neutral rating, and as I said, we have taken a conservative approach when it comes to the cash flows.
Correct. So let's quickly move on though. Return ratios. Let's look at ROCE. That's your return on capital employed. Fairly healthy in that sense. You see that bit of a blip in 2023, but thereafter you see a bounce back towards 20%. And your return on equity though has seen a bit of a taper. You've seen return on equity fall and not really recover fully in 2024. You'll have to wait and watch as to whether that actually plays out maybe in 2025 given the stronger sales growth that we are seeing. Also in terms of shareholding, Mahima, I'll allow you to take that one.
Right. So it's a fairly, well-held company in terms of promoter holding. Overall, if we see the promoter holding, however, has reduced from that 62% mark, which was back in 2022, to around 59, almost 60% in December 2024. But 60% promoter holding shows that the promoters are, very positive about the growth in business. So promoter holding has not, gone down by significantly, but it's gone down from 62 to 59 odd percent, 60 odd percent. In terms of FII's holding have increased from around 4% back in 2022 to around 11% in December 2024. So FIIs are also, have constantly increased their stake in the company. In terms of DIIs, DII stake has slightly increased from that 16.8% mark to around 18.8%. 16% was back in 2022, which was around 17.9 in September 24, and that has increased to 18.8 in December 24. And lastly, public shareholding has decreased, in fact, although September to December, it's almost remained unchanged. But if we compare it to the 2022 numbers, it stood at around 16.2%, which has gone down to around 10.4%. But fairly, it's a well-held company, which is why we've given it a neutral rating for now.
Yeah, quickly moving on to street cred. So neutral on the shareholding for now. But with regard to where the street cred is, you've seen overall the return ratios being, or rather the returns for shareholders, I beg your pardon, being 90% or so since the listing. And therefore a fairly okayish kind of return. Mind you, I'm comparing this to some of the small and mid-cap indices because what we've seen in that space has been very, very strong returns that some of those stocks have given us over the last 5 years. It listed only in 2021 and therefore we may not have the full 5-year data, but whatever it is, 3.5 odd years, that's the kind of return it's given, which is a fairly decentish kind of return, no doubt. But the last 6 months, of course, it's outperformed the market with regard to where the small and mid caps have gone. And overall, it's a decent set of returns, but nothing outstanding, nothing that stands out. And therefore, we've given this overall a neutral on the street cred. Valuations, Mahima.
Right. So valuations for any FMCG company right now does not look cheap, right? Even after the market corrections, the valuations for Dodla Dairy for trailing 12 months stands at around 38, which will go down to around 22 times, estimated 2026. This is as per Bloomberg estimates. Now, this compared to its peers, it is better placed as compared to Hatsun Agro, because Hatsun Agro has a PE of 76 times trailing 12 months, which will go down to around 45 times in 2026 estimated. But as compared to Heritage, it is in line with what Heritage PE looks like, because for Heritage Foods, the PE stands at around 33 times, and for Dodla Dairy, it's at 38 times. But again, having said that, compared to peers, it's fairly better placed. But 38 times is definitely not a cheap valuation, which is why we've given it a neutral rating.
Okay, so that's neutral on the valuation picture. Let's look at analyst recommendations. 4 analysts cover the stock, all 4 with a buy rating. And what you're seeing is a likely 31% return potential on this one. So growth essentially is going to hold the key, and so are margins. Let's quickly look at all of our metrics and quickly rate this one before we go and have a conversation with the management. In terms of metrics, let me start off with income statement, thumbs up, balance sheet, thumbs up, cash flow, neutral, return ratios, neutral, that gives it a 3. And then you have shareholding, neutral, street cred, neutral, valuation, neutral, and street coverage, positive. Overall, giving it a rating of 5.5 on 8 and no thumbs down. So that's the other thing that really stands out. We didn't see any of those metrics looking bad per se. But let's go across. We have Sunil Reddy joining us, Managing Director at Dodla Dairy, to talk to us about exactly this. Mr. Reddy, thanks for joining us this morning. Good speaking with you. I want to first start off by understanding from you what the downside risk to gross margins as well as overall margins can be. Employee costs have gone up for you, at least in this financial year. You've also seen a likely possible amount of pressure which might come from raw material prices. Has the pass-through actually happened with regard to raw material prices? And what's the outlook for H1? How are you insulating yourself?
First of all, thank you so much for getting me on your show, and good morning to you guys.
Good morning.
The H1 numbers, normally what happens is when we are in a season where milk prices go up, it takes a bit of time to transfer it to the consumers, because we wait for at least, let's say, 2 or 3 payment cycles, which will mean a month or a month and a half before we see prices stabilizing and then pass them on to the consumers. So the drop in that 1 month and a half, and if there are 2 kinds of price increases, if we get a 1 quarter of lower price increases, it will show that overall a drop for that quarter. Right now, we are seeing to be maintaining even standards, because I think the price increases did happen in mid-Feb and a bit of March, which we have been able to take the corrections and pass it on to the customers. But largely that is what has been happening in H1. But also H1 is another change that we will see is sequentially, depending on the weather. If summer is really warm as they're predicting it to be, we will see a huge change in product mix. We get more offtake in high return products like curd, buttermilk, and other such products which are also higher margin. Even though the price might go up, we might be able to maintain the same margin profiles as we are doing now.
Right. Mr. Reddy, you said you'll be able to maintain the margins, I believe, within the range of 10 to 11%. I just wanted to understand that the value-added products, the percentage to sales has increased significantly over the past few years, right? Right now, it stands at over 30%, right? So I wanted to understand as to, because you've also said that your focus will be on value-added products, because that is what will aid your overall margins as well as top line. Where do you see this overall percentage to sales going in terms of contribution from value-added products, let's say 1 year or 2 years down the line? And then do you see your margins going beyond that 11%?
Basically, normally, I think we'll try to maintain these levels of margins rather than taking up the margins, but we will be more keen in terms of letting to see how the volume expands. two things that happen here. Once in the value-added products that you're seeing today, what we have defined it as value-added is non-milk products, which majorly is led by curd. This year, as you saw the inventory coming down, we had a big number of sale coming in from what we sold as ghee and what we sold as powder. So we are trying to concentrate more on the ghee to make ghee become the next larger value add sale that we'll do from a B2C point of view. Second, coming to the percentage of margin, we more look at the absolute number that we make. The way I tell people is that depending on how we want to look at growth versus supply, we look at it as saying if I need to go and make 10,000 rupees by selling 10,000 liters, I can make that by selling one rupee on a liter. Or if I have an opportunity, I'll expand my market to 20,000 liters and make 50 paisa per liter and still make the 10,000 rupees a liter or 10,000 rupees of money. The reason I say this is we have to make that call of sacrifice between growth and margin. And that's what we try to play with and see where it goes. Second thing is we do not want to take up prices to be significantly larger in terms of the milk or the other products because also it has its own impact on the consumers who will suddenly start consuming less. So we would like to balance that and keep it at these margins. We try to get our bottom line expansion more as an absolute number.
And Mr. Reddy, give us insights. How do you plan to stand out in this industry? Raw material costs would be the key risk for you, and therefore, what is it that you're doing which is unique, which other players are not, and insulating your margins at 11%? What gives you that confidence?
See, basically, like I said, our uniqueness will be that once we call ourselves a dairy company and not an FMCG. So, we are in that middle stage, right? The front end is FMCG, but the back end is dairy. So when we call ourselves a dairy industry, we must be very careful that our back end procurement always is a key focus area where we have to keep looking at optimizing it, making sure that the costs come down. The earlier days, you would be listening to us talking about going directly to the farmer, trying to eliminate the middleman and get margins both to the farmer and the company. Similarly, as we go, we'll be bringing down the collection radiuses by having more smaller kind of chilling centers where the transport will try to make it more economical to make more better on the procurement side. And third, the dairy industry is also sort of insulating one state against the other. For example, Karnataka will one day be a very expensive proposition to buy, and next year it might become a cheaper proposition, and vice versa Maharashtra. So it's the skill of managing all the four states, making them become more in terms of which pricing, which state, where we're procuring. And bottom line is, it's a boring thing, but we have to keep the eye on the ball. It's a 365 days of a year, keeping track of what we are doing, and that's the key to it.
Okay. Mr. Reddy, in your con call, you had mentioned that you are looking for inorganic growth opportunities. I wanted you to, expand a little on that. It will be in terms of expanding into different distribution centers geographically, or are you also planning to add some more products to your portfolio via these inorganic expansions?
Primarily, I think immediately our inorganic expansions would be more focused on milk and milk-based. Other portfolio additions, we've not found anything, but if we find, it'll be of a much smaller scale, more than a learning curve for us rather than a major push to come with. But it'll primarily inorganic, we'll only look at milk and milk-based plants.
And what about distribution? One is you're going to go into Maharashtra in a big fashion. Second is currently you have 24 LLPD as your capacity. How quickly does that get exhausted, and 10 LLPD from Maharashtra comes on stream? Where does that go in terms of geography? Just give us that highlight. And how are you going to fund some of these inorganic as well as organic growth?
So fundamentally, I think if you look at it, we have with us cash of close to 500 or 600 crores that exists with us, which is in terms of we do it as our investments which are left with the treasury that we are operating. And every year that we keep adding cash. So mostly we will be only using our internal accruals, both for our inventory buildup if it happens and the expansions that we do. We might do borrowing from banks if required for the sake of interest arbitrages, that opportunities that exist. But fundamentally, we are only going to be using our own internal accruals to fund our growth as we go forward. Regarding capacities, we have, once we talk of, let's say, including Maharashtra, it will be a 34 lakh liter per day capacity. Out of that, we will have 5 to 8 lakh liters of capacity going for the seasonal variation, which is milk powder. When we have surplus milk in the system, that gets converted to milk powder. But otherwise, we will be looking at a 25 lakh liter per day as a regular capacity to keep going. So that would be our target that we hope to achieve in the short term.
Okay, thank you so much, Mr. Reddy. Actually, a very interesting conversation, but completely out of time on this one. So thanks for coming in and giving us all of that perspective. Of course, that's Mr. Reddy from Dodla Dairy, but completely out of time on this one. From Mahima, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.